We came to Richmond to talk to someone making a lot of news, a lot of headlines. Jeffrey Lacker joins us for this entire half hour. President Lacker, great to be here.
Great to have you here, Tom.
It's bright, it's cheerful. It's like the Lacker redo. The kids comes through here. How are you trying to engage kids in boring stuff like economics?
Well, you have to take the kids where they are. This is aimed at middle school kids, but also kids of all ages. And we thought it was really important to teach them what the Fed's about, but also what the economy's about and what market's about. The main message is markets are you. You are markets. You participate in markets. You make economic activity happen.
There's so much going on every time you speak. I mean, you go out to, let's say go down south in the 5th District to South Carolina. You're talking to people. They want to know about jobs. They want to know about housing. And the major media just wants to know about line 3, page 42 of a speech you gave or the chairman gave or the minutes gave. How do you bring together your work day to day in this 5th District with the Lacker total media focus on Lacker and monetary economics?
Well, we go out around the district. We take trips several times a year, spend a couple of days, identify people we want to talk to, companies, community groups, see what's really going on in the area. We always include a bigger event and a speech and invite the national press. And at those events, I'm acutely aware that I'm speaking to two audiences. I'm speaking to the audience at hand, and that's how I craft my speech. But I've got the national media there, and I realize they're going to be parsing the policy relevant sections of my speech with great care.
It's going to be a break exclusive here, folks. I saw you earlier with your security badge on. How would the employees of the 5th District teach you when you wear a New York Giants lanyard in their face all day? I mean, they're dying Redskin blood down here.
Well, I've got some other Giants fans who are employees down here. A great guy, Oscar Barr from North Carolina, is a big Giants fan too. He works at the cafeteria and the meat line and on the counter and everything.
They're all closet Keynesians. I know how that goes. Let's get to work here. Inflation. Brad DeLong, dreaded first chart. Bring it up here, folks. We're going to look at it down here on a monitor here in the 5th District. DeLong disagrees with Lacker. Brad DeLong says, come on, if it walks like a duck, quacks like a duck, it's a duck. There's core inflation. Down it goes. Not a big deal. And that you, Plosser, and others suggest we need to look out further. Tell us the distinction between DeLong of Berkeley and Lacker of Richmond.
So two things. First, I'd point out that overall inflation has trended above core for several months now. Right. And we've experienced a period of years in the mid part of the last decade where overall was notably above core. Our objective is overall. That's what drives the purchasing power of money. And I think if there's a divergence over time in those two, you have to take into account and focus on overall inflation. Moreover, the other thing we're looking at is a lot of anecdotal reports suggesting that firms are looking to the second half of this year to make up for some of the margin squeeze they're seeing. They're getting squeezed by higher input costs, higher healthcare costs. And we've heard over the last couple of weeks several anecdotal reports related to firms thinking they're going to have more pricing power in the second half of the year.
Let's look at Jack Welch at General Electric years ago talking about the inability to pass it through. Is this time different, a la Rogoff and Reinhardt?
Well,
Do they need to pass through that inflation to the consumer?
Well, we'll see. They're either going to do that or they're going to take it somewhere else to make up those margins. So we're going to be watching really carefully. It's not a done deal that inflation's going to accelerate this year, but it's this time in the recovery where the potential for inflation accelerating is highest.
Bring up chart number 2, if you would, folks, back in New York. This is chart number 2, folks, as we come to you from Richmond, but all our technological stuff coming from New York. 5-year forward break-evens. It's a measure of inflation. This is Lacker-friendly, and that we're really back to where we were before the crisis when you try to game out the yield curve where we are. The University of Michigan survey on inflation. Michael McKee telling me this constantly, showing those worries out there. How far out the curve do your research economists suggest we see inflation? Is it 2 years out? Is it 5 years out?
Well, that 5-year break-even, the 5-year break-even, the near 5-year break-even, suggests that market participants think inflation is going to trend back to 2, maybe a little higher over the next couple of years, 2 to 3 years. And I think that's a better indicator than the low level of core inflation that is running at right now.
QE2, I see a distinction not only in Richmond literature but elsewhere, this idea of the confidence we can bring in that balance sheet and also the timing of it. Which is of greater concern to you? Getting the timing right, or are you concerned about the mechanism to bring in the balance sheet as well?
Pretty confident we have the mechanism under command, on our command. I think we know what to do. We know how to do it. The timing and the pace are the key swing variables. Those are the things that are just really hard to get. Back when we were just operating with interest rates, you saw the last expansion. We raised rates at a very steady rate,
right,
and a very gradual rate. Back in '94, we raised rates a little more herky-jerky, big moves, pause for a while, big moves. We got a greater increase.
Right.
So getting the timing right when you start raising rates or start withdrawing monetary stimulus, and then getting the pace right. Those two things are both very important.
I like that word. That's good. Continue a little more, Jeff, on inflation. Let's bring it up right away here. The balance sheet. This is a great chart, folks. We've shown it many times before, but I want to take it away. Bring it up here. Chart 4, Rex, if you would, in New York. There it is. There's the persistency, the buildup of the Fed, nice and responsible. Oops, there was a crisis, and it just continues to get a little bit big here as you look at Federal Reserve assets. Is it all clear yet?
So there's further increases in the size of our balance sheet ahead as we follow through on the program we announced in early November. In addition, I'd note that there's an additional bump to the monetary base that's going to come from the fact that the Treasury is going to roll off the supplemental financing program, this $200 billion slug that they've drained of reserves through issuing short-term debt. They're going to have to roll that off to get ready for the debt ceiling run up, and that's going to add another $200 billion to reserves over the next couple of weeks and months. And so even though we started this program in November, bank reserves haven't increased that much over the last month or two. They're going to increase a lot in the next 2 months.
Does anybody ever raise their voice at a Fed meeting? Does it ever get, you know, I mean, the Eccles building, and they were in there in World War II figuring out what to do. And, you know, I've been in the room, the table's like, you know, 2 football fields long. Does anybody ever get upset?
No, it's
because the media's like Lacker, Ploss, or Rick Mishkin, whatever, you know, whoever the players are.
It's exceptionally polite. In fact, even genteel. The custom around the table is to address each other as, you know, President Plosser, Mr. Chairman. So it's very, very polite.
But I had a girl from Georgia once tell me those Southerners, they kill them with kindness. So I don't know. It may be genteel, but who knows what. Let's go. Chart number 3. Let's bring up chart 3. This is a story of the moment. We're going to get the word here from the economist, young Jeffrey Lacker. Bring up food here, right here. Food is exogenous. I asked Christina Romer about this. I'm asking everybody about this. There's the UN Food Index. This explains a lot the unrest in the Middle East. That's inflation-adjusted, real food worldwide. I want you to tell your viewers watching this in Virginia right now that the grocery bill you don't care about.
Oh, I absolutely do. I mean, it's part of the basket of food, and it's one of the more visible things people see. Back a couple of years ago, I fell into the habit a lot of Fed people have, talking about what was going on with core inflation.
Right.
And I'd have people raise their hands at the end of the speech and say, do you guys at the Fed actually eat food or drive cars? And the point obviously being that excluding food and energy didn't make any sense to them, and I think they're right. So I talk about overall inflation.
2 questions. Academically, are we beginning to nudge ourselves back pre-Burns? Are we going back to a greater respect for headline, or are we still wedded to core at the Fed?
I think academically, we've always known overall inflation is what we care about. That's our objective. In many times, core is a better predictor of overall inflation going forward than is past overall inflation. And that's the reason people talk about core so often. But I think it's tricky, and you got to reassure people that it's overall inflation that we care about. And these food and energy prices are definitely a concern.
Just because of time, I want to jump forward here. Folks, the cover of the 2009 Federal Reserve report from Richmond. I'm sorry, I need to get a life. I actually read annual reports from Federal Reserve banks. It's better than Ambien. Anyways, here it is. This is a research. There's a gorgeous report right there. And let's bring up a quote from there. This is Kartek Athria. This is a great quote, and this is the wheelhouse of Jeff Lacker research. This is on systemic risk. We're going to bring up the quote. Observed contracting arrangements may be important in promoting efficient trade between parties from before the shock. That's supposed to say shock, not stock. Shock, yeah. Before the shock perspective. That was my typo error there. Sorry for that. But before the shock, we want to get ex ante and not ex post. We want to get out in front of the shocks. Do you have any greater confidence we can do that now with Dodd-Frank and with our new humility?
We have much greater tools at our disposal to be able to contain risk and contain the fallout and the incentive distortions that result from the moral hazard of a huge federal safety net. But I'm a little chagrined that we didn't take more steps to clarify the boundaries around that safety net. So I think the main problem is the one that he highlights in his annual report, which is that without having made a firm commitment about who's in, who's out of the safety net, policymakers in a crisis are just driven by the ambiguity around their previous commitment to expand the safety net more broadly than they would have wanted people to have expected.
This is critical, folks. This is too big to fail. Let's trash on Jamie Dimon versus the idea of, wait, we had a safety net that was trying to do too much. John Weinberg's got one of the coolest jobs in the entire Fed with a research history of this bank, and Tom Humphrey's work years ago. Lacker and Weinberg credibly scaling back the safety net. What would you take away from the safety net? Fannie and Freddie?
Absolutely. I think winding them down, as the president's, the Treasury's report suggested last Friday, is absolutely got to be front and center on the agenda for reforming our government policy towards housing finance.
Well, what else? Let's continue this. I mean, everybody else is focused on too big to fail. Henry Kaufman wants smaller banks. Simon Johnson wants smaller banks. Jamie Dimon pushes back and forth. And you're saying, am I right? That's not the debate?
The debate ought to be who's in the safety net and who's out, being clear about who's in, regulating them appropriately, and then letting the rest deal with risk on their own. I think the markets are capable of doing that, and I think that requires a clear commitment for us to stay out of the process of bailing out large institutions that are outside the safety net.
Let's bring up this note of the day from one Jay Lacker. I want to bring it up right now, folks. You'll see it down here in the monitor. President Lacker. Here is the note of the day, a new approach to Fed housing policy. There's some real humility here in your note. Home ownership is a good thing for many people, not for everyone. I could see some politicians telling the smart mouth economists to shut up there. If we're going to promote it, we should recognize that and tailor our policies accordingly. The Lacker policy on housing. Everyone should own a home.
No, and the president's report, the Treasury's report, recognized that Friday as well, that when they talk about promoting home ownership, it's not about every American owning a home. Rental is much more appropriate for many people. It's important to recognize in housing finance, there's sort of two separate questions. One is, do we promote home ownership? And the second, how? We've promoted home ownership through a heavy reliance on subsidies for housing debt. I think the last crisis shows how dangerous that can be. If we want to subsidize housing, the thing to do is subsidize housing equity. Through things like the Roth IRA, encourage people to save for a first down payment.
Some kind of tax adjusted account for a down payment saving. And I want to bring up now the op-ed, this in the FT today, and you can see here in the first two sentences just a terrific, simple statement by the young boy from Cairo. There was a time as a young child in Cairo when I believed that Egypt could do anything. Mohammed Al-Arian, Jeff Lacker, the culture of Richmond, and those photos of Richmond in 1865, and you and Ed Ayers are planning a sesquicentennial and all the emotion around this. Your thoughts on an Egypt that now will attempt to pick itself up, much like Richmond in the South had to pick itself up 150 years ago.
When you think back on history, it's stunning over the last 2 centuries how the Western world in America and the South has picked up its standard of living, just how well off people are compared to how they were in antebellum South. And when you look around the world and you see countries held down with stagnant standards of living, and you see them take action on their own like they did in Egypt, that gives you hope that they can sort of throw off those shackles and begin improving their economic condition as well. It really
There's so many things to talk about. I want to talk about Jeff Immelt. What should the president do with Egypt? What's the economic prescription? Should the U.S. flood them with aid?
I'm not sure that's been proven very effective. Bill Easterly, others in the development economics community have heavily critiqued the large flow of aid to some countries, and it doesn't seem to have a reliable relationship with subsequent standards of living.
Just because of time, I want to bring up the deficit. Let's look at this research note, folks. This from the Fed's wonderful regional focus. Steve Slavinsky here. Let's bring it up. There it is. What textbook models seem to miss is how the revenue stream to pay off the debt is structured. Economists have pointed out that the current tax code is biased. I mean, this is a big challenge, this fiscal deficit. Weigh in here as a chairman is weighed in. What do we need to do now to right the fiscal ship?
In the past, we've run big deficits and then gotten the debt to GDP ratio down afterwards by running surpluses and paying off the debt more rapidly than GDP is growing. I'm heartened that the president has submitted a budget that makes progress towards that. But if you look at the implications of that, the debt to GDP ratio rises and then plateaus. I don't think it's sustainable for people to come to expect that in recessions, when the deficit balloons, the debt to GDP ratio rises again and then plateaus off. That's a recipe for a stair step upward that's ultimately unsustainable. I think we need more progress than we've seen.